So we're going to look at GNUS Brands, and this company has been all over the Facebook groups, people going crazy buying the stock and making tons of money on it because it was trading so low. Now it's trading a little higher. So what I usually do is I try to value a company using a discounted cash flow model, and I enter financial information about that company into the model. Then we estimate the future free cash flows of the company, and then we discount those cash flows back to today's dollars, and then we compare the intrinsic stock price to the actual stock price to see if it's a buy or a sell. We also look at financial ratios at the end. GNUS Brands was formed in 2013 from the merger between A2 Entertainment and GNUS Brands / Pacific Entertainment. So GNUS is a global media company developing, producing, marketing, and licensing branded children's entertainment properties and consumer products. They also have Kids GNUS Channel, which is a video on demand channel. And let's look at their financials. So I entered all the information into the spreadsheet. I have their market cap of $393 million, the stock price of $5.14. That's what they're currently trading at, but that was 10 minutes ago. It could be a lot different right now. It's at $5.49 now. You have to update your model every 5 seconds with this company. I entered the free cash flows. Every year it's negative. They are a startup, so that's not uncommon for a company to be using more cash than it's bringing in. Net income is also negative, and that is common also with a newer company. They're spending a lot more than they're generating. Their revenue it went from $1 million in 2016. I'll show you in Yahoo Finance. So that's 866.875, not 866,875. So that's $866,000 in 2016. And then they did $5.3 million in 2017. Then it dropped to $1 million. And then it went up to $6 million. So it's kind of up and down. Not the best picture when you invest in a company. Now we need to look at the capital structure of GNUS to see what the discount rate is we need to apply to the future cash flows. So they pay $807,000 of interest on their debt. They have $2.4 million of short-term debt, that's due within 12 months, and $3 million of long-term debt, that's due after 12 months. So they pay a hefty interest rate, 15%. I could get a better interest rate than that. So, but I guess they're a startup and they're a risky bet for any debt holder. I don't know their effective tax rate because it's not too clear looking at their income statement. So I'm going to use a blanket 20% tax rate. So the cost of the debt is actually 11.8% because even though they pay 14.8%, they get a tax deduction on that. So it's 11.8%. So only 1% of the capital structure is debt. So that's a good sign. And they have a high beta. It's a volatile stock. I'm surprised it's not even higher. That means it moves 2.4 times the market. And the cost of equity is 21%. So to get the WACC, the weighted average cost of capital, it's a blend of the cost of equity and the cost of debt. And it's 20%. That's a discount we have to apply to the future cash flows. So we estimated the future cash flows at negative $2 million in next year, then nothing for the remaining time. And I'm not saying it's going to be this way. This is just a standard model. And I actually have 4 models, 4 discounted cash flow models in this spreadsheet, and this is the most conservative model. The other models made it much more negative, the result. So because there's no way to predict a positive outcome when all they report is negative. I can't predict the future, and I'm not going to even try. So this is just based off of their financial information, and I'm sure they're going to be positive if they don't go bankrupt. So obviously when we discount the cash flows back, the value of the company is negative. So the stock price can't be really negative. So the stock price is zero. It's worth nothing. But people don't invest in what something's worth. They invest in what it's going to be worth. Because if people only invested in what things were worth, then a lot of stocks would be zero. And people look to the future. So the stock price has been all over the place. It was high a few years ago. Then it dropped to a few 20, 30 cents maybe. Then it jumped up, and all the people on my Facebook groups were going crazy, saying how they're making so much money, and then people who didn't buy it were upset. I didn't buy it, of course, because I'm a value investor, and I don't buy and sell. So to put more color on it, stock prices are based on supply and demand. The more people that buy the stock, it pushes the price higher and higher and higher. The more people that sell the stock, it goes lower. So we didn't get much information on running a discounted cash flow model, as I suspected. You can't really get much information when they only report negative, and especially for new startups. So let's look at their ratios. So I entered the current assets, which are cash, accounts receivable, inventory, current liabilities, which is accounts payable and current debt, equity, which is total assets minus total liabilities, and earnings before interest and taxes. So the numbers don't look great. The PE is negative because PE is stock price over earnings per share. They don't have negative earnings, so it's a negative PE. And then price to sales is price over sales per share. I like to see under 2.2. This is 66. So that's way out of the ballpark. Price to book, I have to see under 4.3, but they have a terrible book and also a weak price. So that's a bad ratio. Current ratio, if it's under 1, that indicates they can't afford to run their day-to-day operations, which is obviously the case. So they have to continue taking on debt until they can. An exit strategy is to get acquired by a bigger company. Then they can grow even faster. Negative ROE. And I did Disney, which is in the same sector as GNUS. And as you can see, Disney has much better ratios. It wins in every category except debt. Disney has 3% debt. They both have low debt.